Open. Data center land transactions hit $3.3 billion in Q1 of this year. That's a single quarter, up 141% year over year, according to Bisnow's sourcing on RCA and CoStar transaction data. To put that in context, the entire industrial land transaction market, warehouses, distribution, flex, light manufacturing, didn't move anywhere near that velocity in the same period. And here is the institutional red that most people are missing. When one buyer class moves that much capital into a specific land type, they don't just reprice their own asset class, they reprice everything adjacent to it. Every industrial site, every flex campus, every mixed-use parcel that sits within a power-proximate corridor just got a new ceiling on its land value, and most of the people selling those assets haven't figured that out yet. That's the dislocation. That's the allocation question, not whether data center land is a good bet. That ship has sailed, but whether you have the site control, the power access, and the operator relationships to convert a position before the window closes. The data layer. Let's start with the numbers, because the velocity here is not normal. $3.3 billion in data center land transactions in Q1 2025, 141% year-over-year growth. Those figures come through RCA and CoStar pipeline data, aggregated and reported by Bisnow. For reference, the previous record quarter for data center land acquisition was itself a post-pandemic anomaly. We are now more than doubling that. Who is transacting? The hyperscalers are the primary buyers. Microsoft, Google, Amazon, and Meta have all made public disclosures of multi-billion-dollar infrastructure commitments in their most recent 10K and 10Q filings. Microsoft disclosed over $80 billion in planned capital expenditure for fiscal 2025, with data infrastructure as the primary driver. Meta guided towards $65 billion in capex for 2025, up from prior guidance, explicitly citing AI compute infrastructure. Amazon's AWS has been the most geographically dispersed, acquiring land in Virginia, Texas, Ohio, Indiana, and expanding into secondary markets like Mississippi and Wyoming specifically for power availability, not population density. But the hyperscalers are not the only buyers. CBRE's 2024 Global Data Center Trends Report identified a second tier of acquirers, colocation operators like Equinix, Digital Realty, and Iron Mountain, plus a growing cohort of private capital-backed developers, Aligned Data Centers, Tract, Green Mountain, and newer entrants like Stack Infrastructure and Compass Data Centers. These are the operators writing the development checks that don't show up in public filings, and they are actively underland controlled in every primary and secondary market right now. Now here is where the comp bleed matters for everyone else. JLL's Q1 2025 Industrial Market Report flagged anomalous land sale pricing in Northern Virginia, the Dallas-Fort Worth Metroplex, Phoenix, and Columbus. In each of those markets, industrial land that would have cleared at $8 to $12 per square foot 18 months ago is now being bid at $18 to $35 per square foot, not because industrial demand changed, but because data center developers set a new ceiling. A 200-acre parcel outside of Ashburn, Virginia that CoStar tracked as a logistics play in late 2023, traded in Q4 2024 at a per-acre figure that implied $28 per square foot of land, roughly 2.5 times the prior industrial comp in that submarket. The buyer was not a logistics developer. Green Street's power infrastructure research from late 2024 documented the same effect in Phoenix's West Valley corridor and in the I-35 corridor north of Dallas. CBRE Econometric Advisors is calling this shadow repricing, where land adjacent to utility substations, transmission corridors, or existing fiber routes gets bid up by data center scouts running site selection criteria that have nothing to do with traditional industrial demand drivers like port proximity, labor shed, or intermodal access. The mechanism, power scarcity, is the actual constraint, and it's a harder bottleneck than capital. Here is the mechanism in plain terms. A hyperscale data center at full build-out consumes between 100 and 500 megawatts of power. A large logistics warehouse, say, a 1.2 million square foot Amazon fulfillment center, draws roughly 5 to 15 megawatts. The ratio is not 2, 1 or 5, 1. It's a full order of magnitude. Data center developers are not buying land because land is scarce. They're buying land because land with confirmed power access is scarce. And the only way to secure that power access in a constrained grid environment is to control the land first and negotiate interconnection agreements from a position of site control. The grid is the binding constraint. The North American Electric Reliability Corporation, NERC, flagged in its 2024 long-term reliability assessment that two-thirds of North America faces elevated or high risk of energy shortfalls over the next decade. That assessment was written before the most recent round of AI-driven data center announcements. PJM Interconnection, which serves 13 states plus DC and is the dominant grid operator in the Mid-Atlantic and Midwest, has a current interconnection queue that exceeds 280 gigawatts of requested new load and generation. Average wait time for large load interconnection in PJM is now running 4 to 6 years in contested zones. So what does a data center developer do? They find land where power is either already delivered or where they can negotiate a direct utility relationship, what's called a large load interconnection agreement or, in some jurisdictions, a special contract with a utility. Those agreements require land control, which means the land bid isn't speculative, it's a queue holding mechanism. The land purchase is the interconnection application in economic terms. That's the mechanism. It's not about data center demand being high, although it is. It's about power-entitled land being a non-replicable asset in a constrained grid environment, and the only way to hold that position is to own or control the dirt. Where mid-market capital fits, the hyperscalers are writing $500 million to multi-billion-dollar land checks. That's not where the opportunity lives for capital moving sub $100 million. The opportunity is in the conversion gap, parcels between 20 and 150 acres, currently zoned or permitted for industrial or flex use, located within 2 to 5 miles of a major substation or transmission corridor, where the current owner has not engaged a site selection consultant and has not run a power access analysis. These deals are being marketed as value-add industrial. They're being underwritten on rent PSF, cap rate, and logistics demand. The broker has not pulled a power availability map. The seller does not know what they have. I'm seeing this most acutely in 3 structures. First, direct land acquisition with a speculative rezone and power pre-application. Buy the land at industrial comp pricing, submit the interconnection pre-application and large load inquiry simultaneously, hold for 12 to 24 months, and sell to a data center developer or operator with power entitlement in hand. The basis differential between industrial land and power-entitled land in markets like Phoenix, Columbus, and San Antonio is currently running 60 to 150% in favor of the latter. Second, structured option agreements, where you don't buy the land outright, you control it via a 12 to 24-month option at industrial pricing, use the option period to run the power and permitting diligence, and either exercise into a full purchase or assign the contract to a qualified data center developer. Capital efficiency on that structure is substantially better. You're deploying option consideration, not full land acquisition capital. Third, joint ventures with regional industrial developers who already own the land but lack the operator relationships to execute a data center conversion. You bring the relationships and the capital structure, they bring the basis. The most overlooked submarket segment right now is the 50 to 200 acre parcel in secondary power corridors, the I-70 corridor in Ohio, the I-10 West corridor outside San Antonio, the suburban Atlanta submarkets outside of Douglasville and Covington. These are markets where hyperscalers have announced intent but not yet executed site control. The land is still pricing off industrial comps. That window is compressing. Counter positions and risks. The bears have legitimate arguments and I want to be precise about them. First, interconnection timelines are genuinely uncertain. A 4 to 6 year queue in PJM means that even a well-positioned land play may not deliver power for half a decade. If the AI capex cycle cools or if one of the hyperscalers pulls back commitments, which Microsoft has already done selectively in a few markets, pausing some leased capacity deals in early 2025, you're holding land at a premium basis with no near-term monetization path. The land doesn't cash flow while you wait. Second, utility policy risk is real. Several state utility commissions, most notably in Virginia and Georgia, are actively reviewing large load interconnection priority rules in response to residential ratepayer advocacy. If a commission ruling changes the queue priority structure, the entitlement thesis changes with it. Third, there is a speculative land bubble risk in the Tier 1 markets. Northern Virginia land pricing in Loudoun and Prince William counties is, in some transactions, pricing in data center development assumptions that require 100% occupancy at top of market colocation rates from day one. That's not underwriting, that's wishful thinking. If you're buying Tier 1 data center land at those comps, you're not early, you're late. The correct response to all 3 risks is the same: buy basis, not narrative. If the land works at industrial value and has optionality to data center value, you have a margin of safety. If you're paying data center premiums on land that still needs 5 years of entitlement work, you don't. The position I'm taking. Here is what I'm actually doing right now. I'm focused on 3 things. First, I'm running site-level power analysis on every industrial and flex land deal that comes across my desk. Specifically, I'm pulling GIS layers on substation proximity, transmission line routing, and utility load interconnection queues before I look at any rent or cap rate assumptions. If a deal is within 3 miles of a 138 kV or 345 kV transmission line and the land is under 40 acres per megawatt of potential load, it gets a second look regardless of the stated asset class. Second, I'm actively building operator relationships with Tier 2 and Tier 3 data center developers, the aligned, tracked, and stacked tier of the market, because those are the most likely buyers for mid-market land positions. A hyperscaler is not buying your 60-acre Columbus parcel. A regional colo developer with a 40-megawatt build program absolutely will, and they are actively undersighted right now. Third, I'm structuring into option positions rather than outright land purchases wherever the seller will accept it. The option structure allows me to run a 90 to 180-day power and entitlement diligence window without full capital deployment, and in this environment, sellers in secondary markets are still taking options at industrial land pricing because they don't yet know they're sitting on something different. The specific markets I'm most active in evaluating right now: the Columbus, Ohio metropolitan area, specifically in the Licking County corridor where Intel's Ohio 1 campus is creating infrastructure pull, the San Antonio I-10 West corridor, and to undisclosed Texas secondary markets where utility infrastructure investment has run ahead of data center site control. I'm not buying hyperscale adjacent Tier 1 land in Ashburn or North Phoenix at current pricing. The basis doesn't work unless you have a specific operator lined up before close. I want the markets where the infrastructure is there but a memo hasn't circulated yet. Close. Here is the summary. $3.3 billion in data center land in 1 quarter repriced not just data center land. It repriced every power-proximate industrial, flex, and mixed-use parcel in every affected corridor. Most sellers don't know it yet. Most buyers operating outside the tech infrastructure world are getting priced out of markets they've worked for decades without understanding why. The allocation question is not whether data center land is valuable, it's whether you have the site control, the power access analysis, and the operator relationships to convert a position before the window closes. Buy basis, run power diligence first, and structure for optionality if you can't get conviction on the full thesis at close. If you're a broker with a site you think fits this screen, or a principal looking to co-invest on a structured land position in any of these corridors, DM me at @BrodyOfficial. I route those conversations personally.